So we'll look at credits. This is going to be an introduction to credits, and we're going to look at the actual individual credit requirements for each credit in a separate video of its own. Uh, a credit in the tax formula is down here. It comes after the total tax liability calculated based on the taxable income, and it basically reduces the tax liability. So if you see here, this was the tax liability, and the credit reduced it to where the taxpayer only had to pay this much. So let's take another look at it and see what exactly a credit is. So a credit, as I said, is something that reduces the tax liability as compared to a deduction, which reduces taxable income. So far we've looked at a bunch of different deductions, the standard deduction. We've also looked at the dependency exemptions, which also work as a deduction in terms of reducing the tax liability. A credit reduces the tax liability dollar for dollar, whereas deduction only reduces a percentage of the tax liability. Because the deduction really isn't reducing the tax liability directly, it's reducing the taxable income, which reduces the tax liability. It will be clear when we look at an example. John has gross income of $50,000. He also has a deduction of $3,000. His tax rate is a flat rate of 25%. Now, I just want you to ignore, the standard deduction, because we're gonna just assume that these are the only facts, and he has a flat tax rate. We're not basing this on a real life, person's tax. So, if we were to take the tax liability for John on the original $50,000, it would have been $12,000 and $12,500. If we reduce his tax liability by the $3,000 deduction, so if he was to get a $3,000 deduction, the benefit is this: it reduces the taxable income to $47,000, and then as a result, now the tax rate is calculated on this lower taxable income, which brings it to $11,750. So this is really what John's tax liability would be with a $3,000 deduction. So what it really means is that John is getting a savings of $750 from a deduction of $3,000. So that $3,000 deduction will reduce the taxable income, which when multiplied by the tax rate comes up to be a lower tax liability than what it would have been without the deduction. So another way you can look at it is the tax deduction multiplied by the tax rate, effective tax rate, is how much the taxpayer would save. This has other factors to it, so this is just a simplification, a gross simplification of it. So you can think of it this way. So if someone was in let's say in a 10% tax bracket, they would only save $300. In this case, they are in a 25% tax bracket, so they save $750, because it's a direct correlation between their tax rate and the deduction. However, a credit, on the other hand, works differently. Now, the same scenario, but let's say John has a credit of $2,000. So he has taxable income of $50,000, and he has a credit of $2,000 instead of a deduction for $3,000. So his tax liability again on the $50,000 would be $12,500. But the credit would reduce the tax liability. See, the credit reduces the tax liability, not the taxable income. So the credit is reducing directly dollar for dollar how much he would owe, and the tax liability ends up being $10,500. So a credit of $2,000 reduced the tax liability by $2,000. So I ignore this only because it just carried over from the previous slide. So a credit of $2,000 reduce the tax liability by $2,000, a dollar for dollar benefit. Another thing to be aware of is that there are refundable credits and there are non-refundable credits. A non-refundable credit can reduce the tax liability until zero, but if there's any excess credit left over, it just remains unused. Whereas a refundable credit can reduce the tax liability to zero, but if there's still a credit left over, the taxpayer can get that back as cash paid to the taxpayer. Let's look at an example. Now, let's say John has a tax liability of $3,000. We're going to look at 4 scenarios. The first scenario is that John has a non-refundable credit of $2,000. So $3,000 tax liability minus $2,000 credit means $1,000 tax liability. Pretty simple. John has a non-refundable credit of $4,000. So now the credit is more than what the tax liability is. So John has a negative $1,000 tax liability. And a negative tax liability really means John is owed money. But in this case, because this is a non-refundable credit, there will be no there will be no cash paid out to John. He cannot receive this as a refund because it's a non-refundable credit. Now if we switch it to a refundable credit, the first scenario is the same. $3,000 tax liability reduced by $2,000 credit means $1,000 of tax liability that remains to be paid. Now if he had a $4,000 refundable credit, the negative $1,000 tax liability, which again really is it means that John is owed $1,000, will actually be paid out to John, and he will receive a $1,000 refund because it is a refundable credit. So we're going to look at the different types of credits that we have, but the very first one that you can think of a refundable credit is the taxes the taxpayer pays throughout the year, the amounts that are withheld from a taxpayer's weekly check, the federal withholding. That is basically money that they've paid. If they've paid more than what they should have paid, they will get that back because that is a refundable credit. And then we also have the earned income credit, which is a refundable credit. We have the child tax credit, part of which is refundable, as well as the American Opportunity Credit, which is an education credit. So those are the few that I could think of that are refundable credits, and then we have others that are non-refundable that will just reduce the tax liability up until 0, but the taxpayer cannot get a refund.